Larry Fink and BlackRock, the man who built a shadow superpower. New York City, mid-1980s. On one of the upper floors of an office tower, a young bond trader in a white shirt and loosened tie is staring at a screen that has just given him very bad news. The numbers on it represent mortgage securities, the sliced up bundles of home loans that have become one of Wall Street's favorite toys. Interest rates moved in a way he did not expect. Trades that looked brilliant a few months ago now look catastrophic. He's no longer just a rising star. He's the man whose desk has just lost his firm hundreds of millions of dollars. His name is Larry Fink. Larry Fink grew up in a middle-class family in California, the son of a shoe store owner and an English professor. He studied political science, not finance, at UCLA, then drifted toward Wall Street in the 1970s almost by accident. At First Boston, an investment bank, he found a niche in the bond department. This was not the glamorous stock trading floor of old movies. It was rows of people staring at blinking numbers, building a new market in mortgage-backed securities. Fink was good at it. He helped design products, build relationships, brought in revenue. For a while, he looked like the model Wall Street success story. Young, ambitious, and at the bleeding edge of a complex, lucrative market. Then those trades went wrong. Interest rates rose sharply. The value of the mortgage bonds dropped. The losses were pinned to his unit. He kept his job for a while, but the message was clear enough. On Wall Street, you could be brilliant and still get blindsided if you did not understand your risk. The experience left a deep mark. He would later describe it as the most important business lesson of his life. If you want to play in markets, you cannot just focus on returns. You have to know, in excruciating detail, how much you can lose. By the late 1980s, Fink has left First Boston. He and a small group of colleagues decided to start something new. They do not want to be just another trading desk. They want to build a firm that combines asset management with serious risk analysis, offering institutions not only returns, but insight into what could go wrong. In 1988, with backing from Steven Schwarzman's Blackstone Group, they form a company. They call it BlackRock. At first, BlackRock is modest. A few people managing bond portfolios for pension funds and insurers, obsessing over duration, credit quality, and interest rate exposure. But from day one, the culture is shaped by Fink's scar tissue. Everything is about measurement. They build systems to track, scenario test, and stress portfolios with an intensity that at the time is unusual. Risk is not an afterthought. It is the core product. As BlackRock grows, its engineers and quants develop a software platform to keep track of the firm's own positions. They need a way to pull in prices, model correlations, stimulate shocks, and see at a glance how a change in one corner of the market might ripple across a whole portfolio. They call this internal system Aladdin. Over time, they realize that Aladdin itself is a valuable product. If it can help BlackRock see its risks, it can help other institutions see theirs. So they start offering it as a service. Banks, insurers, pension funds, even other asset managers start to use Aladdin to monitor trillions of dollars in positions. It becomes quietly one of the central nervous systems of modern finance. If you sit in a risk office at a big institution and pull up a screen showing your exposures, there is a decent chance that somewhere under the hood, Aladdin is running those numbers. BlackRock is no longer just a firm that manages assets. It is a firm that rents out its eyes and nervous system. In the early 1990s, BlackRock separates from Blackstone, goes public, and keeps expanding. It is still mostly a fixed income house at this point, known for cautious, well-hedged bond portfolios. While other firms chase hot equity market, BlackRock builds its brand on being steady and analytical. Then, in the 2000s, it makes a series of moves that change its scales entirely. It acquires asset management units from larger banks. Most dramatically, in 2009, in the wake of the financial crisis, it buys Barclays Global Investors, including the iShares exchange-traded fund business. ETFs are a simple but powerful invention. Baskets of securities that trade on exchanges like stocks. They allow investors to buy an entire index, sector, or theme in a single trade, often at very low cost. By swallowing iShares, BlackRock vaults into the vanguard of the passive investing revolution that John Bogle helped start. Over the next decade, as trillions of dollars flow into index funds and ETFs, a huge share of that money flows into BlackRock branded products. Somewhere along the way, BlackRock crosses a threshold. It manages more money than almost any institution in history. Pension funds, insurance reserves, sovereign wealth funds, corporate treasuries. Millions of small investors buying ETFs in their retirement accounts. It runs index funds that track broad markets, sector funds that slice and dice them, active strategies, quantitative products, alternatives in real estate and infrastructure. If you zoom out and look at the shareholder lists of major public companies, you see a pattern: Vanguard, BlackRock, State Street, again and again. Together, they own large chunks of corporate America on behalf of their clients. BlackRock does not tell these companies what to make or how to price it, but it votes on their board elections, executive pay packages, and major mergers. Larry Fink, the bond trader who once blew up a book of mortgages, now sits atop an institution whose fingerprints are everywhere. In the 2010s, Fink begins to do something interesting. Each year, he writes a public letter to the CEOs of the companies BlackRock invests in. He talks about long-term value, corporate purpose, climate risks, workforce policies, governance. He argues that companies should think beyond next quarter's earnings call, that they should manage environmental and social issues not out of charity, but because these things affect their ability to generate cash in the future. He does not sound like an activist storming a proxy fight. He sounds like a patient, slightly stern investor saying, "We are going to own your stock for a long time on behalf of people saving for their retirement. Do not burn the future for a quick pop in the share price." Some applaud this. They say someone with that much voting power should use it to push for more responsible capitalism. Others bristle. They accuse Fink of overreach, of trying to impose his own politics on companies, of dressing up preferences as neutral risk management. In some circles, BlackRock becomes a villain for doing too much on issues like climate. In others, he becomes a villain for doing too little. The fact that it can be criticized in opposite directions is a clue to how central it has become. If you peel back the public debates and look inside BlackRock, you find something less conspiratorial and more industrial. Thousands of employees in glass towers around the world, sitting at screens, running models, talking to clients. Portfolio managers who live and die by basis points. Risk officers who worry about what happens if interest rates jump, if a country defaults, if markets gap open in a panic. Engineers constantly tweaking Aladdin, adding data feeds, refining stress tests. There are committees for investment decisions, committees for governance, committees for technology allocations. Fink is the figurehead, but the day-to-day engine is diffuse and systematized. BlackRock is, in a sense, the embodiment of a particular belief that finance can be made safer and more efficient by quantifying everything that can be quantified, diversifying across everything that can be owned, and running it all through a common risk lens. Whether that belief is always true is another question. Critics sometimes call BlackRock and its peers shadow superpowers. Not because they secretly pull political strings like a movie villain, but because the sheer size of the assets they manage gives them influence that is not neatly captured in traditional charts of power. They do not own the money. They are agents for others, but agents with discretion. They can decide how to vote proxies, which funds to launch, how to interpret vague shareholder mandates like maximize long-term value. If they decide to favor certain corporate behaviors and punish others, the market feels it. Supporters argue that this is just what large fiduciaries do. They try to shepherd client money away from what they see as long-term risks. Skeptics worry that a small number of firms, headquartered in a small number of cities, staffed by people with similar educations, will converge on a narrow view of what prudence means. That too much of the world's capital is being steered by too few hands, even those hands are technically acting on behalf of millions. BlackRock sits in the middle of that argument like a mirror. When people talk about it, they are really talking about what kind of capitalism they want. Larry Fink himself is a curious figure in this story. He does not have the folksy charisma of Warren Buffett, nor the cowboy flair of a private equity baron. He speaks in the measured cadence of someone who has spent a lifetime in conference rooms and on investor calls. He talks about long-termism, about retirement security, about the need for companies to serve all stakeholders. He also talks about technology in a way that reveals where he thinks the real leverage is. Aladdin is not just a tool, it is part of BlackRock's moat. The more clients use it to see their portfolios, the more those clients are plugged into BlackRock's way of understanding risk. The more scale BlackRock has, the lower it can drive fees on its products, making it hard for smaller competitors to keep up. Fink is not simply managing assets, he's managing a platform. There is an irony at the heart of BlackRock's story. The revolution that made him massive, the shift into low-cost index funds and ETFs, is, in spirit, deeply Bogle-like. It is about shaving costs for investors, giving them broad exposure, reducing the need to pick winners. But index funds do not decide which companies exist in the first place. They only decide how much of them to own once they are public. The question of who gets capital at the beginning, who gets to try to build something that will someday be big enough to go into an index, is answered somewhere else in the financial ecosystem, not in glass towers of asset managers. In an older, more concentrated corner of the market, private equity. Private equity firms do not mainly buy slivers of thousands of companies. They buy control. They borrow large sums of money, use it to acquire entire businesses, then try to change them, restructure, cut costs, spin off divisions, load them with debt, fix operations, and eventually sell or take them public again. The classic version of this story plays out not in trading rooms, but in boardrooms and hotel suites, in quiet negotiations and sometimes hostile battles. One firm, more than any other, etched that story into the public imagination. Its name stands for three founders: Kohlberg, Kravis, and Roberts. KKR. They were dubbed barbarians at the gate for the way they stormed into corporate America with leveraged buyouts. Next time, we will walk into that world. We will sit at a table where a handful of people decide to borrow billions to take over a company. We will see how the private equity playbook works from the inside, and we will ask where discipline ends and pillage begins. If Larry Fink and BlackRock showed us how one firm can quietly sit on top of the world's savings, mostly by owning tiny pieces of everything, KKR will show us what happens when finance decides it does not want a piece of a company. It wants the keys.